If you're looking for ways to diversify your portfolio and you have an appetite for risk, but don't want to invest in the public markets right now because everything's going to shit, well, keep watching this video because in this video, I'm going to show you exactly how you can do that. If you want to see more financial tips, passive income ideas, and strategies to build wealth, then be sure to head over to our Instagram page at Jayconomics to find your way to financial freedom. I also share my journey and quick thoughts on Twitter, so follow me there to stay updated on stocks that I'm currently investing in, how I'm making passive income during this recession, and more on Twitter at RealJayconomics. And now, let's get into it. If you want me to keep making videos like these, then please hit that like button, hit that subscribe button, as it does help a lot. It helps get the video out to more people, and that is the mission of Jayconomics. Now, as we all know, high-risk investments are obviously that. They are more risky, but they can also come with higher potential returns. Now, some high-risk investments can provide 10 to 20% or even higher annual returns, and some even with dividends, although rare. Now, if you're someone with an even higher risk tolerance, there are also investments that are riskier than high-risk investments, but can provide 1,000% plus returns. Now, however high your risk tolerance is, which everyone has their different risk tolerances associated to their situations, right? You should always diversify your portfolio with various types of investments. One good opportunity is through equity crowdfunding, which is exactly what we're going to talk about in this video. Now, you can do private investments, which are companies that aren't publicly traded. Investors often seek out private investments because there is potential to earn returns that are just better, flat out better than public equity. Now, it's also a good diversification opportunity because it's not directly correlated to the stock market, which we all know is struggling right now quite a bit for the last year or two, and will likely continue to struggle until the economy is on the rebound. Now, keep in mind that this isn't where you should put your entire portfolio. It probably shouldn't also be where you put most of your portfolio. Again, I'm not going to speak for everyone. Everyone has their own situations. But it does present an opportunity to put a small portion of your portfolio if you want something with higher risk and higher potential returns. So if that sounds interesting to you, well, how do you get started exactly? Well, think of it kind of like Dragon's Den or Shark Tank, right? Or venture capital investing, where you invest in startup companies that have not gone public. Keep in mind that private companies are not required to provide any information at all to the public, so it could be very difficult to analyze their financials and profit trends. In fact, investing in private opportunities was actually restricted by law to high net worth Canadians until only recently. And if you guys don't know, well, this is exactly how the ultra wealthy get and stay ultra wealthy. But now, with various online platforms, which I will mention later on, so keep watching until the end, they allow anyone to invest in private companies, and you can invest in small amounts, right? So you could start at $100 if you want. Obviously, you could put more than that if you'd like. So you would invest in startup companies. Think Dragon's Den or Shark Tank, venture capital investing, private investment funds, private real estate, all that kind of stuff. Now, if you're a Canadian, then this is how we can use our TFSAs or RRSPs to our advantage. So you can invest in certain private companies using your TFSA or your RRSP. Any returns made into your TFSA are completely 100% tax-free. That's the beauty of the account. It's in the name. Yes, it's tax-free. Now, any funds you remove from your TFSA actually increases your contribution limits the following year. So let's try an example here. So let's say you invest $50,000 in your TFSA into startups. Let's say 60% of them fail and 40% of them succeed, right? Because with startups, a 40% success rate is actually very good and you're going to make a lot of money. Okay, so let's say you turn that investment into $1 million from 50,000 and you withdraw it. Well, your contribution limit for your TFSA the next year is now $1 million plus. Repeat, you can hold your entire investment portfolio inside your TFSA. right? So again, this is obviously when things go right. But again, a 40% success rate, it's not super high, right? But you will still make a lot of money that way investing in startups. Now, most institutions like TD or CIBC, BMO, they're not going to hold exempt securities in their plans. So you cannot use an account from them for your investment. But some online crowdfunding platforms work trust companies that specialize in private markets, such as Western Pacific Trust Company, ComputerShare, Olympia Trust, Community Trust. And these guys, they all accept investments through TFSA or RRSPs. So now let's get into how this would all be possible for us Canadians. And I'm going to talk about two platforms. So one of which is equivesto.com and the next one is frontfunder.com. And they both allow you to invest in private companies. Now let's start with Equivesto. Equivesto was founded in 2017 and it is catered towards Canadians and helps Canadian businesses grow with the support of their own community. Now, their mission is to close the equity gap and private investment access while also helping the underrepresented founders secure the capital that they need, right? So again, access for all, making things a little more fair. So the other platform I mentioned is FrontFunder, which is the leading online private markets investing platform in Canada, and it has a very similar mission to Equivesto. They've helped raise more than $120 million for businesses so far. So again, look at both, see which one speaks the more to you. Maybe you like one of the user experiences better. They're obviously very similar. In order to start, you would assess the companies that are available on each platform and then choose which ones are right for you. Now, let's say you find one that you like and you're like, yes, I want to invest $10,000 in this private company. All you got to do is you wait for approval. The team from whichever platform you're on is going to review your profile. That is required by law, actually, to make sure that the investment is actually a good fit for you and your situation. And the last part of the process is to fund your purchase through an online method. It's really as simple as that. So very, very simple. Now, you guys are probably wondering like, okay, well, let's say I make that investment. How am I going to see a return on my investment? There are three ways that you can really see a return on your investment. So when a company makes an acquisition, you can either sell your shares or receive shares. When the company goes public, when and if a company goes public on a stock exchange, you can sell them on the open market, just like you would any other stock. And then when the company generates extra cash, they could potentially choose to issue dividends to shareholders. So those are really the three ways that you would be able to get an ROI from investing in a private company on one of these platforms. What should you look for when you're investing in private companies? I'm going to tell you what I look for. So first thing would be the product market fit. So again, as an early stage investor, I'm going to want to know that a startup's product holds value in the customer's eyes and that over time, more and more customers are going to recognize that value. So this means asking the big questions. What is the problem and how big is that problem? And what is the solution? Is there a strong demand for that solution that people are actually willing to pay for? The answer is yes. Obviously, that's a great sign. Second thing I really look for is, the macro factors. What is the environment? So if you want to be an extremely successful early stage investor, it's very important to kind of zoom out, take a step back and ask yourself, where is the world going? You got to be able to pick up on trends and predict what the future is going to look like. So the best way to put it is really like, look into it, look into your mind, create your vision of the next 5 years and use it to guide your investments. The third thing is the differentiation and the business plan. So let's say you're looking to invest in a new age, early stage music streaming startup. Okay. So, what are the things that you're going to ask yourself? Well, how does this new app compare to a market leader? like Spotify, right? Why would anyone use this new app instead of Spotify or in addition to Spotify? Once you identify a key differentiator, you need to ask yourself, how is that team going to execute that vision? Is there a solid business plan in place? Remember, most startups are going to fail. It doesn't mean that they cannot fail and come back in a new form or pivot or whatnot. But again, just most startups are going to fail. So if the startup you're considering investing in hasn't properly mapped out its path to market and its path to profitability eventually, you probably should think twice about investing in that startup. And the last thing that I really look for is the people, right? Because people make everything. So who is part of that management team? Who are the founders? So when you're investing in early stage startups, above all, you're investing in the people building them. Okay, so for me, it's crucial to be able to picture the founder or founders leading the charge internally, or else I would not really trust them to manage my own money, right? So again, here are 5 of the most crucial things a founder really must check off in order for me to trust them in building their startup. So 1, a clear vision. 2, genuine passion for that project, because otherwise, I don't know, that's a major red flag for me. Balance of humility, right? So you don't want them to be too arrogant, because then if something gets brought up, or if, you know, a better way of doing things gets brought up by their teammates or by anybody else, if they think they're always right and they don't want to be humble about anything, watch out. That's major red flag. A strong mindset, very important. Things are going to happen when you are building a company that are not expected, that are extremely difficult. Things never go according to plan when building a company. I can speak to that. I can attest to that myself, having built a few companies now. And so you need someone or people that are going to be very resilient. And, you know, when the chips are down, they need to step up. So strong mindset, very important. And the last one would be confidence. So, you know, you don't want founders to be kind of like gun shy. You don't want them to be, you know, very passive. You want them to be aggressive. You want them to be, to know what they're doing and to have confidence in what they're building, right? If they can't see the end vision for themselves and really believe it, I mean, that project is doomed to fail from the start. So those would really be the five things that management needs. So that wraps it up for today. If you enjoyed this video and it brought you some value, or you just enjoyed this new kind of format and this, you know, these kind of new topics, then, you know, hit that like button, subscribe, come back, leave a comment. I love to read your comments, and I'll try to get back to you as soon as possible. And yeah, so thank you so much. Take care. Bye-bye.